So if you're invested into anything in the stock market at the moment, this is the picture you're most likely waking up to every day. So we have a list of companies today reaching new 52-week lows, some of them reaching all-time lows. Only positive news today is that Activision was acquired by Microsoft. Everything else is pretty much down across the board. And now it has started to hit also large cap tech names and not just the small cap and medium cap high growth companies. So this is interesting to see, and even more interesting for me that those small cap companies, although they've been hit hard, 60%, 70% down, they go down even further. So we have HIMS reaching a new all-time low this morning at $5.04. So I thought it would be a good time to make a video to discuss, if you've been watching this for a while, when is the time for you to actually, get into the stock? Is it now already, or should you wait until this level out? Should you wait until it comes back up, or what is the overall strategy for things like that? So I will give you my 2 cents to that, what I've been doing and what I'm gonna continue to do. And yeah, for that reason, I've prepared a little DCF model for him specifically. Um, Obviously, those are my assumptions, so take it for what it is. You will obviously come up with different assumptions, and everyone will come up with different assumptions. But what I've got here is the sales number that is predicted for next year based on the analysts' predictions, assuming a 30% growth going forward, which is quite reasonable if you think about we have a growth of at the moment between 70 and 80%. And then I'm making them break even in 2023 with a 10% margin in 2024 and a 20% EBIT margin 2025 forward. The other assumptions are really just not that material at all. But what I want to show you is here. So calculating all of this, you get an intrinsic value, which the intrinsic value you can compare to the market value, which we have down here. So we have an intrinsic value based on my assumptions of $1.85 billion, which compares to the market cap, which is the price of the share, which is the outstanding shares times price of the shares at the moment, which is $1 billion. So just along from my comparison, if you would ask me, is the stock currently undervalued? I would say clearly yes. Based on my 5-year cash flow model, I have an implied target upside price of 91% at the moment already. So you can see that there's already a huge upside just based on today's price. But the question for you is, when do you scale in, right? So you would look at a stock like HIMS, and you see that the price to sales ratio is 3.5. So for a high growth stock, you would have assumed that this is quite low. You still need to compare it to something else in that industry or the competitors or to other high growth stocks. How does that actually compare to? Because just by judging of the number alone for HIMS, you can't really tell if 3.5 is low or if 3.5 is the number that should be the right number. So I've actually looked into trying to find a comparison. It's really hard for sort of HIMS to find actually a competitor, because then they don't really have a direct competitor in that niche market. But if you look at telehealth as such, we have companies, of course, like Teladoc, which is a way larger company and more generic healthcare, but they are sort of in a similar sector. If you think about like that, we have a median enterprise value to revenue of 3.3. So if you think about how does that compare to others in the industry and to other companies, this is actually quite in line. Of course, there's other high growth companies, high growth tech names that have a much higher price to sales ratio, but that's probably not as you can't really take them as a comparative like judging of something like a Twilio would have a much higher price to sales ratio because they can actually increase their revenue even higher than HIMS, whilst we're only assuming a 30% average revenue increase going forward, which is strong, but it's not as strong as some other tech names. So we do think that 3 point something, so anything that was a 3 seems reasonable at the moment, because obviously also these other companies here, that list, so especially TDoc, have been hammered down by these interest rate fears and inflation fears at the moment. So basically it is in line with all the other companies that have also dropped. But overall, everything is cheap at the moment. So I would say it's still a deal at these levels. But you could have asked yourself, okay, but we still are a bit unclear about interest rates and what's going to happen going forward. So should I scale in right now or should I wait? So for that reason, I've done a little simulation here based on my cash flow model. I thought about factors that could potentially affect the stock price in the near future. So let's assume there's nothing bad happening with the company and nothing else. I really come up with only 3 big items, micro and macroeconomically, that we have at the moment. So we do have the inflation fears, ongoing inflation fears, which ultimately result in interest rate hike fears, which are priced into a degree, and that's also the reason you woke up today to new all-time lows. But what about higher than expected interest rate increases? What about, the Fed comes out and says, no, we're not going to do 4 times 0.5% increases. We actually have to do a 1 or 2% increase, which I think would shock the market yet again, because I think they're expecting increases, but they're not expecting high increases. So then this is definitely this would push the price down further. Then we have Omicron fears and related supply issues. Since we're not doing really lockdowns anymore, if we had lockdowns, Omicron would actually be counter-affecting the interest rate and the inflation fears. But since we are not doing it anymore, Omicron is more like delaying, like worsening the whole supply issue that we have at the moment. So which would actually increase inflation even further, potentially increasing interest rates even further as well. So basically those 2 macro factors would, in the medium term, would push the prices further down if we have any surprise there. Then in terms of the microeconomic environment, so the company specific news, obviously analysts have dropped their estimates from last year. So I've been looking into that. So last year we had a 70 to 80% revenue increase. Analysts are actually assuming that this is going to drop to a 33%, which I assume is going to be 30%, which is quite a significant drop. So, I mean, those are obviously analyst assumptions. It's only 5 analysts covering this. So there could easily be a surprise to the upside when it comes to revenue, which would or should push the price higher. So we have 2 macro factors pushing price down. One that would affect the price to go higher. So what I've done with my cash flow model is I've looked at, okay, obviously this cash flow model doesn't affect the market cap. The market cap is whatever the market thinks is the value at the moment using their own imaginary cash flow model. But for my cash flow model, if I put an 18%, which would be a 3% increase in interest, obviously the stock price would be heavier discounted, so the current value of the company would go down. So it would actually increase from my level of 1.85 to 1.6 billion. And then what I've done is looked at, okay, what is that increase or decrease in percentage terms? So a 3% increase in discount rate equals a 14% decrease in company value, which I then applied over here to the market cap just to see as a rough estimate, what would happen, what could potentially be the impact if we had a higher rate increase. 860 million is what I've got then. giving an EV, enterprise value of 800, and a price per share of 4. Obviously quite a bit lower, so a 20% decrease to the current price. But which is already low, but let's say we assume that the revenue would go up. So we would actually, without that, we would have a price to sales ratio, if we use current revenue numbers, of 3. And if we assume that the revenue surprises, so let's go with next year's revenue, which is actually just the conservative estimate, your price to sales ratio would be at 2.3. So and obviously the upside potential from, if you compare it to today, 91% around that level based on my model, to $4 would be 140%. So you would make an additional 50%. So the question is, should you wait now, or should you scale in already? Because obviously I've made those kind of assumptions, and they're kind of radical assumptions, and you're sort of betting on a surprise here, and a negative surprise on the macro environment to push the price down even further. My sense of that is, if you look at an initial calculation that we did here, and we saw a 90% upside potential, for me that's already a significant upside that I'm taking here with kind of more or less conservative estimates, actually, which could actually potentially be much more in terms of sales, especially. So I'm thinking that if you like the stock at those levels with potential upside of 90 to 100%, then you should already scale up, because you just can't bet on any surprise in the market. You never know what's going to happen in the market. It could be that we've seen yesterday China actually decreasing interest rates because of economic slowdown. So just think about it for a moment. If the US were to came out and say, well, actually, we've analyzed everything, and we're not going to increase interest rates, or we're going to increase interest rates only 0.5% in the first quarter, which, based on my opinion, is already priced in. So if that were to happen, then the stock price would probably go up 20-30% within weeks, and then you would have missed out on that nice low price at 5. So for me, it would not be worth it. So I've actually scaled in already at $6, so I'm currently down, which is it's totally fine for me, because I know that I'm buying into a high growth story here, and I'm happy to wait out until this plays out, and I know that I've sort of bought a piece of the business, and I'm not afraid of losing unrealized losses or having unrealized losses of 20-25%, as I know that I'm comfortable in their story and their brand and their projected revenue growth going forward, because I think that in terms of their size, a 30% revenue growth with super high 70 to 80% margin, I mean, there's a potential huge upside there. I got a comment yesterday about share increases. I mean, obviously that would affect the market cap. So if you think about it, the market cap is the price of the stock times the shares outstanding. So if you increase the shares, the market cap, like your ownership that you have, would go down. So you would be what's called diluted. I've actually looked at the current quarterly results, and I didn't see a significant increase in shares. That's alarming. I mean, obviously we had that super high increase last year when they did the reverse merger, but since then we have a 91 to 93 to 203, basically around 5%, nothing too alarming. It's pretty normal in this kind of type of environment. So that factor I didn't really put in here, as I thought it would be too insignificant based on, I've already lowered my assumptions and made it pretty flat. As I said, it's a high level calculation. So yeah. So my 2 cents is I personally, I've already bought into it at 6. I'll continue to buy at 5. I'm not yet quite there at the level of position that I want to have. And obviously, if it were to drop at 4, I might reassess again and buy even more. But I do like it at 5, and you just really can't bet on these prices to go lower and lower because you know that it's $1 billion market cap. It doesn't take much money, especially institutional money, to push this up 20, 30%. And then you're looking at a $6 and suddenly you realize, oh my God, I missed out on this super opportunity to buy it at $5. So yeah, those are my 2 cents. Let me know in the comments if you've already bought into HIMS or if you're planning to start a position, or if you don't like the stock at all, then please recommend, of course, another one that you like. And see you next time.